Welcome back to Tactical Value Investor channel. Today we are going to talk about why I don't always hold stocks forever, using my Starbucks trade as a real world example. I bought Starbucks in May 2024 at $74 per share and sold less than a year later for $113, a 50 percentage gain. But here's the real story. I didn't sell just to take profits. I rotated that capital into two faster growing companies. Let me walk you through the why behind each move. Back in May 2024, Starbucks stock had just taken a hit after a disappointing Q2 earnings report. Headlines were all doom and gloom: union pressure, inflation, slowing sales. But I looked through the noise and focused on the fundamentals. I believed in the core business, which was still strong. The brand was intact, globally recognized, and still expanding. International growth potential was there, and the valuation had come down to a more reasonable level. At the time, I actually thought this could be a long term hold. It felt like a high quality business that was temporarily out of favor, and I saw an opportunity to buy in while the market was overly pessimistic. Early this year, I sold Starbucks at over 50% gains because at that time I saw a lot of other attractive opportunities. I took the gains and rotated that capital into NVIDIA and Intuit, two companies I view as long term compounders with faster growth potential. Here's why: NVIDIA is at the heart of the AI infrastructure boom. Intuit, it's quietly dominating personal finance and small business tools. Both companies have strong growth, high returns on capital, and long term tailwinds. One may look at hundreds of qualitative and quantitative data points, but I looked at two filters: how far the stock was from its all time high and revenue growth, past and projected. Starbucks gave me a solid tactical win, but to keep compounding, I needed to reallocate to businesses with a higher growth trajectory. Let me show you how easily I do the growth rate comparison. I'm on this website called Stock Analysis. Under Stocks, there's a comparison tool. Under that, there are multiple subtabs, but I created my own view by clicking on Add View. I selected the fields that I'm interested in while researching and comparing companies and saved it as TVI, Tactical Value Investor. I prefer to invest and hold companies that have double digit revenue growth rate. If you look at Starbucks revenue growth rate last 5 years and next 5 years, it's in single digit, while they are in double digits for NVIDIA and Intuit. Now let me zoom out. Some investors swear by buy and hold forever. And that works if the business keeps compounding and the valuation stays reasonable. But in reality, not every stock deserves to be held forever. Sometimes the thesis plays out, the valuation gets rich, and your capital can work harder elsewhere. That's what tactical value investing is about: being patient and intentional. It's not just buy and forget, it's buy, monitor, and reallocate when the math makes sense. So, what do you think? Would you have held Starbucks or made the same switch I did? Drop your thoughts in the comments and I would love to hear your take. And if you haven't seen my full HSA portfolio breakdown, check out my first video on the channel. Thanks for watching. I'll see you in the next one.